All right, so let's figure this out. I want to make sure that your investment strategies, your investment objectives align with your value and align with the time that you're able to place into building a passive income portfolio. So I've got a few questions here, 8 questions laid out, and I want you to answer them the best that you can. And if you just go ahead and write this down, keep it somewhere, keep it safe, because I want to make sure that you know exactly what it is you're looking for. That way, when I show you how to evaluate it, you need to know whether it works or whether it doesn't based off of what we're deciding. So I'll ask you these questions, and then I want to show you exactly what it is, the investment objectives that align with our values. It'd be really great if they are both the same and we could work together on that. But ultimately, it matters most what you have put together, right? All right, so what type of property are you interested in owning? Single family, duplex, triplex, quadplex, multifamily? Are you looking at Airbnb? Are you looking at long term? What type of tenant are you willing to host? Are you capable or willing to accept rental assistance like Section 8? How much time are you able to invest? That's a big piece. Are you looking to do a turnkey solution, or can you put sweat equity into the deal? The acquisition, renovations, management, paying the taxes, making the repairs, all of that stuff. Are you able to invest in out-of-state properties? This one plays a key part in opening up markets for you, but you have to have proven systems and you have to work with experienced teams in order to make that work out profitably for you. What's your exit strategy? Are you holding long term, or are you holding to sell and recapture appreciation and capture appreciation? I don't know. What type of purchase? Are you willing to put debt on the property? If you put debt on the property, what's your plan for paying the debt back? Do you pay it down as little as possible, or do you pay it down as fast as possible? What are your standards of quality? This is a big one because it really drives the type of product that you're putting out on the market. You've probably heard it before, the slumlords. So you pay as little as possible for a property, and then you never make any repairs, total crap hole, right? This is exactly why I want you to complete the investor self-assessment, because I want to make sure you know exactly what it is that you're looking for. You may not have all the details, but you have this idea, this image, this picture of what a good scenario is that aligns with your values. Really important. So for us, this is what we use. These are the objectives that we use that align with our values, align with our time, and this is the same way that we acquire for our high net worth individuals and physician wealth systems. All right, our purpose is to acquire properties that insurance companies want to write policies on, that banks want to use as collateral to lend us money on, and that renters want to live in and pay us rent for. That's our our three top goals. So we are building a single family residential rental portfolio based on the following details. We purchase with cash and refinance. And you've probably heard the BRRRR strategy before: buy, renovate, rent, refinance, and repeat. We make minimum payments to maximize cash flow and keep control of our capital. No rental assistance program. We don't do any Section 8 or any other rental assistance programs. We're always in Class C or better neighborhoods. And we apply economies of scale in our target markets. We want to keep ROI and monthly net income as high as possible, and we want to keep the loan amount and actual cash invested as low as possible. Ultimately, there are opportunities to create a scenario where there's infinite return. That's where we can borrow more money than we actually had in the deal. That's really good. All right, so the investment objectives that we look at specifically for physician wealth systems when we're building these portfolios is the cap rate at greater than 7%, right? And it's okay, I'm going to explain cap rate here in the next module. And percent of ARV is less than or equal to 92.5%, which means our value, I want to make sure that I can sell this property and not lose any money. So our percent of ARV is less than or equal to 92.5%. Our return on investment, ROI, greater than or equal to 12%, and that's on the finance deal and what I call the adjusted monthly net, the adjusted net The total stacked return, I am so excited to talk with you guys about stacked returns, greater than or equal to 30%. Think about that. 30% return on investment. It's pretty crazy. Monthly adjusted net income on a finance purchase greater than or equal to $200. So each month, each unit, each door is going to provide at least $200 in adjusted net income. That means, I'll show you what that means in the next module. Loan amount. So the loan amount, we look at keeping loans equal to or less than 130,000, less than or equal to 80% of the ARV. If greater than 130, then and all conditions are met, I still consider it, because then it's proportionate increase of the monthly adjusted net income as well too. Loan to value, the LTV, is less than or equal to 80% of the ARV. Actual cash invested, we look at keeping right around 25 grand or less in these deals. And if there's an option where I have to put a little more cash in the deal, then I want to make sure that, again, that proportional increase is there for our net income as well too. Debt service coverage ratio, DSCR, greater than 1.2. And that just means that the bank sees the income can cover the debt payment on it. I put a little note here in the bottom, sweat equity disclaimer. These ROIs are figured for passive investors who are not locating the opportunities, managing the renovations, managing the properties. Remember to count for your time. So if I was, when we first started, my wife and I first started, we were flipping houses, and that was what enabled us to start acquiring properties too. So when I was doing that, I was oftentimes creating that infinite return scenario where I could borrow more money than I had in, because I had sweat equity in the deals. So these are the numbers that we use. Write it down, start tracking the numbers that make sense for you, so you can find exactly what the investment criteria is. So as we track through this process, start collecting data. When we get to the deal analysis with the Mayo calculator, you know exactly what it is that you're looking for, and then we can tell if it matches or not.